are you a stock hodler, or do you have stock hodler mentality? And I don't know if that's hodler or hodler. I'm not sure, but
hodler.
It's hodler, stock hodler. Let me give you the definition of stockholder, please. Okay. The definition is an online trader who clings to their positions regardless of the market condition of what they're doing.
Yeah.
Okay. Do you hold too long? Do you have a sell discipline or not? That's kind of we're going to talk about that a little bit today, whether you're a stock hodler or not. Hodler, excuse me, Don. We're going to talk about disinflation, not deflation. Disinflation. In fact, Zach even came in today and saw my notes and goes, I think you spelled that wrong.
I mean, Don knows.
I said, naturally, that's a term. The Fed,
that does count.
Fed came up with a new term.
Okay.
They've had it for a while. It refers to a decrease in the rate of inflation toward the Fed's 2% target. So it's still inflation. You still have inflation. It's just subsiding.
Wow.
So that's the way they want to talk about it, because it's really not deflation. There's still inflation. It's just lessening. Sure. So that's good. And the Fed's Bullard, he's a St. Louis Fed chair, he said 2023 is probably going to be a disinflation year. And we're going to talk about that a little bit. And then the mailbag. And we're going to talk, we got one comment. So let's get right into it, folks. Listen, welcome to Your Money Radio, the 2023 New Year edition. This is the first edition this year, early in January. And we're going to talk about the Santa Claus rally. Did it happen? We're going to talk about the January effect, first few days in January. Did that happen? No. Well, maybe now. Maybe it is today. And then the whole month of January. All those are going to be important. So in any event, let's get right to it. So Cathie Woods apparently she's a stockholder according to billionaire Dan Loeb, right? Okay. He's a value investor and he's been, but Cathie Woods came out and claimed she took aim at, and where is that article real quick? So let me get into this real quick. This is very interesting. Okay. It says, founder ARC Management could seemingly do no wrong in the run-up after COVID, but with soaring inflation, elevated interest rates, it crushed her exchange fund in 2022. It was tumbled more than 65%. I think the final number was about 69%. And she held big tech stocks like Tesla and Zoom. Tesla, I think, was down 69% year to date. I don't know what Zoom is. One of the guys can tell me what Zoom was year to date, but it was very ugly too. Anyway, Wood, in her defense, said the firm backs companies poised to change the world and doesn't invest in mature ones catering to short-term investors. So basically, if you're bitching about how much money you've lost, you're just a short-term investor. You've got a myopic short-term view. If you don't hang out with me and lose 70% with me or 60%, you're just a short-term wimp.
Right, not cool enough to be at the
It'll
party.
take you 10 years to get your money back, but hey, It's all about the philosophy. It's all about being right.
Yeah.
Now, is she going to end up in an apartment somewhere telling her husband that she was right? Okay, and so Bernard Baruch often gets.
To that end, Zach, if you want to show my screen very quickly, I'll show you the returns of last year of Cathie Woods' top 10 holdings. Tesla minus 69%, Zoom minus 61%, Roku minus 78%, CRSP, oh, this is a good one, only down 29%. EXAS down, Revere down 53%, NTLA 62%, Coin 86%, TDOC 73%, Path 71%. Now, you can take a long-term view if you want to, but you're going to need a long-term view to have any prayer of getting your money back after taking 80% losses, 70-80% losses. Horrific.
Yeah, when you
all right,
lose,
Dan, sorry to interrupt.
That's all right. When you lose 75%, you got to get 300% back before you're even.
Wow.
Think about that. So she's going to have 2 years in a row like her stellar year, or three to even get back even. Okay, now, so in Wood's defense, she said her firm backs companies poised to change the world and invest in mature ones, not catering to short-term, not mature ones, catering to short-term investments. And Dan Loeb, who's a longtime value investor, says, I'm not impressed. He said Woods' memo should be used in classes, meaning college study classes, for the mindset of stock hodlers, a term used to poke fun at online traders who cling to their positions regardless of what happens in the market. He said anyone teaching value investing class or one investment psychology should use this memo to study. Anyway, she defended the firm against criticism, saying that it invests in concept capital and companies that can't turn a profit. Oh, I'm sorry. He was critical of her, saying they can't turn a profit. Wood took aim at firms that added leverage to their balance sheet to pay dividends or repurchase shares, do stock buybacks with borrowed money. Now, that is a little bit of engineering. And if a company is borrowing money to pay your dividend, that is cannibalizing the stock. That's not a good sign. You should be able to pay dividends out of cash flow or out of retained earnings. You shouldn't have to borrow money to pay the dividends. But that doesn't, two wrongs don't make a right. Just because a company shouldn't buy dividend stocks that are borrowing money to pay the dividend, you should look for strong companies that can afford to pay the dividend. But that's irrespective of whether you should hold high beta growth stocks in a crashing growth stock market. You see what I'm saying? Those are mutually exclusive. Those are not mutually exclusive. Okay. You shouldn't buy dividend stocks that cannibalize, and you also shouldn't buy growth stocks that are crashing. But let me ask you a question, Zach. I want to get a layman's answer.
Oh yeah,
not from Don or anybody else. Would you rather have a dividend stock that borrows or cannibalizes a little bit to pay your dividend, and it might decline 5, 10, 15, 20% even? So you got a 5% or 4% or 3% dividend, and the stock's down 20% because dividend stocks have held up better, maybe 15%. Or would you rather have a growth stock down 70%?
First off, I'd go to Revere because you guys know what you're talking about.
Oh, Zach!
Yeah.
Zach just got a raise.
First, step one, obviously.
Zach just hit his bonus,
Thank you.
and it's only the first show of the year.
That's right, first show of the year.
All
Come
right.
out strong.
Anyway, so she said companies in which we invest are sacrificing short-term profits to capitalize on the exponential growth and highly profitable opportunities that a number of innovation platforms are creating. Here's the problem with that. If you invest too early, some of these companies won't make it and lose all of your money. Or they anyway, I'm not saying you don't want to do growth companies. I'm saying you want to do them at the right time and really shrink how much you do in a tough market. Don can talk about that a little bit more later about how, we growth stocks are our primary focus, but when they're not working, we're not in growth stocks. We try to avoid them. And in fact, Don just bought a dividend ETF, to the dividend paying ETF today. We'll talk about that. But we also have cash and treasuries or whatever. So we're not just a one-trick pony. We're not just doing growth stocks. In fact, we try to go where the money flows are going. It's not perfect, but it's certainly a lot better than being down over 20% in a bear market, like almost all stocks, including many, many dividend stocks. Okay? So now we got that out of the way. All right. Does anybody want to comment on that first before we move on? I think Don made a pretty good point there.
Yeah.
It's really enough said. There's nothing you can say. All right. Now, let's move to disinflation. Okay?
Disinflation.
So Fed's Bullard, and he's normally kind of hawkish, said disinflation, said the job market is still strong. The current labor market situation unprecedented with measures of labor demand, meaning there's more demand for jobs, are significantly exceeding the measure of labor supply, people looking for jobs, wanting jobs. He said, now, this is my comment. This is the first time ever young people, there's a big swath of young people that just don't want to work. They'd rather not work, live with their parents, or get money from the government or whatever. But the younger job force has shrunk by over 300,000 to 400,000 people from its norm, right? It's norm. But the younger people, the 20-year-olds, they're not a smaller number in the population. In other words, their numbers haven't declined, and therefore younger people looking for a job haven't declined.
Yes.
Just the younger people looking for a job. And so when you have the participation rate at 62%, just a few years ago it was 67%. So you shrunk the people, the labor force, by 7%. Not that there's 7%, if you just give them a job, a good paying job, they take it probably. But in any event, so in my opinion, the job numbers are the unemployment rate. Let me put it this way. The unemployment rate is artificially low because the way they're manipulating the counting. Now, why do I say this? If you look at the average hourly, that actually went down. That didn't do so well. That came kind of under pressure. Michael and Don can talk about that a little bit more. But the ISM, the manufacturing number, okay, the ISM number is below 50. So that's in contraction territory. That means you're in recession territory. So if you're in contracting territory, how are you creating new jobs? I thought when we contract, people lost jobs. Hell, what do I know? All right. Anybody got any comments on and really the main thing is, what is the reaction to the Fed's numbers and reports? Not really what the reports say themselves, because really what we care about is making money when it's pretty good times and trying to be defensive and losing less or a lot less during down times. So any comments, guys? I'm going to throw that open to you guys. Don, I'll start with you.
Is ISM, was that an employment number, or is that an output number?
That's a manufacturing.
Okay. So that doesn't necessarily reflect that
output.
Indicates minor contraction, which is actually good for the Fed. And I think that the market, when it saw that, it actually went to the upside. The initial reaction of the NFP number this morning, from what I saw, the positive reaction was people focusing on the reduced average hourly earnings, which were below the estimate. Once the market opened, we gapped up about 0.8%, came all the way back to even, and then another spike to the upside, helped by that ISM number that came out at 10 a.m. You know what I'm always going to say, Dan, we're going to go by what the charts are going to tell us. And so far today, the Dow has gotten back above its 21. That dividend ETF that we're watching, SDY, has broken above recent resistance. Let me bring up that chart. Has broken above recent resistance and is outperforming. Small cap growth and mid cap growth are outperforming versus their value counterparts, but but large cap growth is still underperforming. Tesla's down today. They had to cut prices in South Korea. Ultimately, we weigh all this, but as always, we look at the reaction to this, and it's nice to soothe the brain if the reaction is in sync with what the data comes out and there's an explanation for what you think. But like we said in our year-end video to clients, the market will bottom before the economy does, because the market's going to be looking forward 6+ months.
Right.
So my reaction basically is that this is the first bit of good news. The first bit of good news that we've seen in a while, but we still need to get above that key level, which is 3,900. 3850 had been more of a resistance level in the S&P. We're trading at 3870 right now. A close above 3850 would be definitely a check in the box for the bulls, but we really want to get above 3,900. And then the big test, the 200-day moving average, is down in the 3990s now. It broke below 4,000 yesterday. As we know, the 200-day moving average is the big dividing line between a positive and an unhealthy long-term market. And that's where all rallies have failed in 2022. So a change in character to get above that level would be a big positive for the bulls.
All right. And that's actually a beautiful chart right there. That is a nice cup and handle. That seems like you're break. Am I reading that right, Don? The right side of the handle?
That's the SDY. It's really, the handle went deeper than they would have wanted it to be. The pivot is up here higher, but this confluence of moving averages that we broke above today is a good sign for the market and for dividend paying stocks, which continue to lead.
So you're dipping in a little bit early with a tight stop. I got it. Okay.
Right.
But now that still looks a lot better than a Tesla chart.
Yeah, and note that this is above the 200-day moving average, the same as the Dow is, and yeah, it is slightly better.
Pull up a Tesla chart. Pull up a Tesla chart.
Oh boy,
that's horrific. But it did have it has so far had a positive reversal after being down like 7-8% earlier. It's now only down 1.5%. Note the big volume. This is capitulation type volume. It's just a matter of looking for, and it's possible this 100 Livermore level, that's always a big psychological level, but sometimes those psychological levels play a key role. We bottomed today in Tesla at 101.81 up to 108.80 now. We don't bottom fish, but first thing it needs to do is get above this purple line, which is the declining 8 EMA. You can see here several times over the last 3 months, the 21-day moving average, it got up into it and failed. We key on the 21 quite a bit. It's still 19% below the 21-day moving average. Wow. Really a free fall over the last month. Just an absolutely brutal month of December for Tesla.
Right, and so right now it's taking just a bath. At some point, it'll be a buy again. At some point, value investors will start
muddy water.
I was going to say sewage, but okay. It'll start bottom fishing. You'll start getting value investors and kind of support a bottom. And then you've got so many people short Tesla that I think you'll start to see a short squeeze. So you got to be careful, because even if it starts rallying, it'll suck retail investors in, because they'll go, oh my God, it's a bottom. I got to get back into Tesla because I want that stock. Mm-hmm. It'll pop up 8%, 10%, and then roll right back over and go lower. So if you try,
a lot of the shorts have covered. The short interest for Tesla is actually pretty low right now. Let me bring it up. The short interest for Tesla is only 3%.
Wow! So it has
very
gone
low by
very
low by historical standards.
Well, you've had some covering then. All right. So So Michael, do you have any comments on the Fed?
I'll just say that so what I like to focus on is the probabilities of sort of what the market's pricing in for rate hikes. And yesterday for the February meeting, the probabilities of a 50 basis point hike had been increasing a bit. They were around 40%, and then on the news today now they've dropped to about 20%, and a 25 basis point hike is now at 77%. And then going forward to the March meeting, the odds are now increasing for a no hike in March, so being done a pause after next meeting. But the main probability is still at another 25 in March. But we had very low probabilities of a pause, and now those are increasing a bit. And then as far as the ISM manufacturing or non-manufacturing PMI, the market's rallying on that because basically it fell to 49.6, pointing to the first contraction since May of 2020 and the height of the COVID pandemic, and well below the market forecast of 55. And it compares with a reading of 56 last month. And new orders contracted sharply, 45.2 versus 56 in November. And employment also declined, 49.8 versus 51.5 due to economic uncertainty and inability to backfill open positions. So that's what the Fed wants to see. So shows progress that interest rate hikes are doing their job, and the market's now starting to price that in. That potentially, they say the Fed says they focus on the lagging effects of monetary policy. So the effects are starting to show up. So we'll see if they factor that into the next meeting, and we'll take it from there.
Absolutely. Connor, you want to add anything?
Yeah, just something. I mean, I feel like there's like an overwhelming amount of economic data that's always coming out, and it can be difficult to analyze and figure out what it means. So for me, and I think just price never lies, and you can have instances where good data is bad for the market and vice versa. So like Don, to just touch what Don said, I mean, price is the best tool to gauge if it's good or bad, I think.
Connor just got his gold star. If Don could reach through the screen, the monitor, and give him a big wet kiss on the lips, he would.
Yeah.
I guarantee you. Don's
I
going,
think
oh my
I'm
God, I
happy.
love this kid.
I love it.
All right. By the way, I forgot to bring this up at the beginning of the show. Texas Claus
Whoa.
got a very nice
Notarized mail.
Christmas card.
With postage.
Okay. And I was going to give it to him, but he's actually gone. He's up at the North Pole.
Naturally.
He's trying to track down his great uncle once removed, Santa Claus, because he wants to find out, number one, where the hell was the Santa Claus rally?
Yeah.
Number two, what about the January effect? Although this may be correcting right here, right now in live real time. We're recording this Friday morning around 11 Central Time, roughly. And then also he wants to ask what's going to happen in January, because the old adage, so goes January, so goes the year.
So goes the year.
And we're going to talk about those well, let's hit those right now. Don, why don't you start talking about the three different, because people get those confused. Those are three different kind of January season the Santa Claus rally can be late December, but the January effect is really the first week, the first few days, first week out of the gate. And then the so goes January, so goes the year is really more of a monthly. Don, why don't you give the listeners a few stats on that?
Sure. So three different components to this, and this is based on Trader's Almanac. The Santa Rally is defined as the last 5 trading days of a year and the first 2 trading days of the following year. So we had a big rally in the last 15 minutes of the 7th day, which took us from plus 0.1% to plus 0.8%. So first check, the Santa Claus rally worked up 0.8%, but that's below the historical average of 1.33%. So I want to point that out.
Okay.
And then the second indicator of Trader's Almanac is the first 5 days of the year. If the first 5 days end up positive, the year ends up positive 83% of the time. If it's negative, the year it's still a 50-50 toss-up whether it's going to be positive or not. But if you're positive the first 5 days of the year, and the pivot for that is the 12/31 close. So if we're above where was 12/31? 38.40, basically rounding up. If we're above 38.40 and the 5th trading day, which is next Tuesday, when next Tuesday ends, no, actually Monday would be next Monday would be the 5th day. Today's the 4th day. If we're above 38.40, then you get a check mark, a second check mark in the positive column for the first 5-day indicator. And then the third indicator, we have to wait till the end of January to see. That's the so goes January, so goes the year. So that's where we stand with those 3 seasonality indicators.
Yeah, and like I said, we still follow because it doesn't happen all the time. It's not a slam dunk. So you still
we're not making broad decisions based on that. We're keeping it, we're filing it, we're watching it. But ultimately, the individual price action on the markets, the sectors, and the individual stocks is what's going to key our decisions.
Right. And folks, by the way, so part of that makes a little bit of sense because a lot of money. So you got 401k money that employees withhold off their paychecks, and those goes in every couple of weeks pretty systematically, right? But companies do their matching right at or right after year end, that first month in January, but especially the first couple of weeks, because now they have all the payroll data in. So you'll see larger chunks of money going in all at once. And so that kind of helps January or early January to kind of be skewed toward good numbers and a positive outcome. So, and that's why if it doesn't happen, you really kind of want to keep your antenna up and be on guard. So when the January effect and the January doesn't happen, it just gives you more impetus to be ready. So now, one last thing, and then we're going to dive right into the markets. Okay. So it's the mailbag. And folks, listen, if you've got any topic that you'd like us to discuss, a particular stock or stocks or ETF or strategy, you can just email us, dan@revereasset.com, and I will absolutely, we'll bring it up on the air. We'll talk about it. If you've got a stock or, or you can just email me if you want a complimentary portfolio review or just talk about stuff. Or if you got a topic, if you found an interesting article, send me the link and we'll see if we can get it on. Anyway, this is it's actually from a listener, loyal listener, and a client, actually. It says, "Hey, Dan, thanks for the update. I was wondering what you and Don thought about the company Circle.com partnering with Blackrock and the U.S. government to bring corporate treasuries to blockchain. I'd love to, I don't know, I'm not sure what she means by corporate treasurers. I got to look that up. I'd love for you all to take a look at their site and tell me how we may capitalize. I know BlackRock 2023 market outlook hinted that the equities didn't have enough price in, and I wondered how much lower they plan to go. Who knows? Follow the charts. Again, I keep my eyes out and thought I'd ask the professionals." And then she put 3 links on there of what their links aren't on the show notes this time. They'll be on the show notes next time. By the way, I only had a few links this time.
It was a holiday.
Well, we want to talk about the markets. Fed's Bullard 2023 on track to be a deflationary year. Billionaire Loeb blasts Cathie Woods for stonk hodler's mentality. And this is what I did skip this time, folks, because the forecasts are coming out, I mean, from every company everywhere except us. And I've already beat that to death in December, so I'm tired of doing forecast. But it says Bank of America buy stocks. Almost. Got to have that disclaimer.
Almost.
Oh, wasn't quite there.
Yeah.
And Morgan Stanley sees a further slide. Well, thanks. That was helpful. Not. Okay. Anyway, so she's got these 3 articles that actually will be on the show notes next week. So if you want to read them, but we want to do a little deeper dive. And then says, "Thanks for all you're doing to preserve our retirements. It's cold world out there, and we as your customers appreciate having a fiduciary that is actually," that was all in capitals, "actually on our side." So thank you.
Very sweet.
It was very sweet.
Yes,
It was very, and
very
she's a great girl. All right. Anyway, but Michael's going to quickly just kind of lay out what she's talking about, the topic, and then we'll do a deeper dive next week. Mike, go ahead.
All right, so just a brief summary. I read through the article, and basically what it's saying is that it's talking about something called USDC, which is a stable coin operated by this company Circle. And what stable coins are is it's basically a proxy on the US dollar. It's like a digital dollar, and they're designed to give users access to the blockchain without the volatility of cryptocurrencies like Bitcoin and Ethereum. And supposedly what they say is that it allows people to transfer money easily around the globe, including places where the US dollar may be hard to obtain. So what these stablecoins do is they maintain a 1-to-1 peg with the US dollar. And the way they do that is by holding reserves of cash and short duration treasuries. So in USDC, they say they have 20% of their assets in cash and 80% in short-term duration US treasuries. And there's been a lot of speculation that stablecoins don't actually have those reserves to back their currency. So what Circle's doing is by partnering with BlackRock, they're basically it's a way to legitimize their product, and they can hold their reserves in a dedicated fund that they have access to through BlackRock, which is registered with the SEC. And the hope is that by registering with the SEC and partnering with BlackRock, they'll have access. So 80% of those short-term US treasuries, they'll have access to the Fed's reverse repo program, which is something that usually banks and money market accounts only have access to. And what the reverse repo facility is it's basically, like, in simply described, it's a place where these banks and money market funds can lend money to the Fed overnight for the federal funds rate. So they can get a fixed interest rate that's essentially totally risk-free because it's an overnight rate. and they can earn interest on these funds. So it's just a way to legitimize the stablecoin, have it audited and regulated by the SEC, and hopefully instill some more trust. And that's the brief summary of why this is relevant.
Okay, I appreciate that. Now, just to clarify, so the banks can borrow from the Fed overnight. They borrow from the Fed. They can,
well, there's the repo, and then there's the reverse repo.
Right. So what he's saying, so what the Fed does is it's got the member banks, the big member banks, and they got traders at these member banks, and they got to deal with them that they play ball with the Fed. If you want to be kind of a partner, you're going to buy and sell treasuries at our bequest. So when we sell you treasuries, you take your cash out of the member banks and give it to us, and we put it in a lockbox. Remember that from the old days? Mm-hmm. And that takes money supply out of the system. It makes liquidity. It makes money tight, hence driving up interest rates. If they say, you know what, traders, we're going to sell you bonds. I'm sorry. We're going to sell you. We're going to buy bonds from you. Here are the bonds. Here's your cash. Give me the bonds back. And now these banks are flush, and then they got plenty of cash for their reserve requirements, and it lowers rates. So when they talk about the reverse repo or the repo market, that's really just big bond traders at the member banks trading bonds back and forth with the Fed to control the money supply. So they can do it by proclamation, by the discount rate, ergo the federal funds rate. By proclamation, we're going to raise rates by 1/4 point, and or they can suck money out or put money into the system. Okay? So sometimes they may say, we're going to stay pat, we're not going to raise rates, but yet they pull money out of the system so that the rates will slowly creep up anyway. So sometimes they're bold-faced lying, and sometimes they're actually trying to do what they're saying they're going to do. So in any event, that's one reason if you look at the free reserves or the excess reserves, that'll tell you how loose or easy the money supply is. Okay? If you got any questions on that, you can just email me, dan@revereasset.com. Now, my one question, and this is one thing that we'll ask next time. So, Michael, on that structure that you just explained to me, it almost sounds like it's just an ETF or an investment vehicle. It really doesn't quite sound like a pure cryptocurrency, if you will, where you're actually owning the coin. Is that accurate, or are you not? Do we need to do a little more research to figure that out?
Well, you own the coin. The coin is it operates on the blockchain. So it's basically, instead of having a cryptocurrency that's traded and the price, it's basically, there's no way to really value it, which is why it's so volatile. There's so many different opinions of the use cases and what it's going to serve for. It's just basically a way, these stable coins are coins that you own, but it's a way that you can have digital dollars on the blockchain. So if you want to transfer money overseas or use the money to buy things, you can transact. Supposedly it's a lot lower transaction fees. It's a lot easier on weekends when banks are closed and you want to wire money and you have to wait until Monday. You can do this immediately on the blockchain. So it's a way to still use your US dollars, but on the blockchain. And I can get into next week why I personally don't believe it's even efficient, and a decentralized ledger doesn't really make sense. It's a lot more efficient to have a centralized one, but we'll save that for next week.
All right.
But you do own the stable coins.
Well, no, that's awesome. So basically, it's supposed to be pegged to the dollar, and it's going to kind of move in tandem with the dollar. Now, folks, I don't know if you knew this or not, but a couple years ago, we talked about Bitcoin, and we talked about the government rolling out their own crypto dollar, their own dollar. And India's already started doing it. Some other countries have already started doing it. And I said they'll want to do it. They will want to do it because it's about control. They can track every single transaction. So the good news is you get rid of the black market. I mean, because you can track it now. If there's no dollars to trade, you got to do it electronically. But also, there's no privacy anymore either. I mean, then they had, because you can't do a deal, Zach, you and I can't pay you $100 cash.
Right.
I have to pay you $100 with my crypto dollar, or whatever you want to call it, my coin, my dollar coin.
Yes.
Right? So now they've got tracking on that. But I also said the way that they have, if when they're kind of ready to roll this out, they really need other cryptos to really be in the toilet and in trouble, so that that they'd be the savior and you want to go to them. So what more perfect time when Bitcoin's gotten slaughtered, or Ethereum, all these cryptos are really in trouble. It's a perfect time to do that. I'm not saying they're doing it now or getting ready, but when they do get ready to roll it out, I would expect the other cryptos to come under pressure because they want to be the crypto. That's their goal. They are not going to let Bitcoin compete with the US dollar. If you think they are, that's a tough call, man. I'll tell you why. You know why? We've gone to war to protect the US dollar more than once. Okay? Middle East conflicts, it's about the petrodollar. Okay? So in any event, we'll talk about that more next week. Don, can you pull up, is circle.com, is that, let's see, I don't know what the ticker is on that. But anyway, we'll look into that. And
well, I can show BlackRock,
Yeah.
which is really the what gives it legitimacy. This is a chart of BlackRock, and it's not bad. This would be a tiny part of their business that they're dipping their toe into. They're more known for providing as an ETF provider,
Right.
and an asset manager, but it's forming a flat base. It's above the 200-day moving average and the 50-day moving average, but this partnership is not going to be currently a profit driver for BlackRock, but
Yeah.
BlackRock is forming a flat base, and it's above the 200-day and the 50-day moving average. So the chart's solid on BlackRock.
Well, and if the government actually really gets behind this in full force, it could make it profitable for them,
Sure.
Quite profitable. All right. So those are interesting things that we want to talk about. Let's get straight into the markets now. Let's just do a deep dive and talk about what's happening thus far in these first couple days of January and how we're going to proceed going forward. Don, take it away, brother.
Sure. Here's the S&P 500, and for the last 14 days, let me bring up an intraday chart. This is a 30-minute chart of the S&P. This was the positive CPI data that we gapped up on. This was on December 13th, but we sold off intraday. Then the next day was the Fed, and we sold off here with Powell basically saying higher for longer on rates. And then the next day we gapped down. So this is the level, this 39.50 level is the gap where we broke down from the FOMC. And then we haven't been able to get back above 38.89 or 39.90 since then. And the bottom end of the range, you can see how solid 3,800 support has been. We've tapped it basically every day, tapped and or undercut it basically every day, but recovered either intraday or the next day. So today's a good day in the market. We're up currently 1.65% on the S&P, trading at 38.70. We need to get above these recent resistance levels, 38.73, 38.78, 38.90, in order for this to be a change in character. Right now, all we're doing is the same thing for multiple times over the last week and a half, is coming up to 38.90 and failing. Today feels a little bit stronger. It feels a little bit more robust, a little broader in the participation. I'm basically seeing every sector up. I'm seeing small growth and mid growth, as I said, outperforming small value and small growth. That's the complete opposite of what we've seen the first 3 days of 2023. So that's a positive also. But really the key level, like I said, back to the daily chart, we haven't been able to get above this 21-day moving average on a closing basis, going all the way back to the Fed breakdown on 12/14, 12/15. The key level there on the 21 is 38.69. We're trading right there, 38.70. So one close above there would be a positive, but we get 1-day closes above and below all the time. We need a second close to establish that there might be a pattern. And then right above there, we've got the 50-day moving average right above 3,900, and then this big bad black line, which we failed at multiple times in 2022, right below 4,000 now. We need to see below 4,000 and continuing, or above 4,000 and continuing strength to really think that a rally might have legs. So those are really the key levels on the upside. We pounded on the downside at 3,800 so many times and it held consistently. That's the good news. But now all we are is at the top of the range where we historically have been failing over the last 3 weeks. And that's the next hurdle to get over.
All right. Well, that's very illuminating. So really, the 3,900 level is really a really key resistance to break above, and then the next big line would be 4,000.
Right.
All right. Well, that's
Absolutely.
awesome.
4,000 being the key 200-day moving average, and you know the stats, the bear market stats that I track. Traditionally, if you're going to go into a bear market, you start about 12% above the 200-day moving average. This bear market started about 9.5% above, right? And then when we rolled over, part of the exodus and one of the bonuses for staying out of the way below the 200-day moving average is it rolls over, it comes lower, and your signal to get back in is significantly lower than your signal to get out, which in this case, the last one was on 421 at 4,500. So a full 500 points lower versus the 4,500 is where we can get an all clear signal to really start getting heavily back into the market. So you get out, we're getting back in lower than we were able to get out. And that's been a consistent theme in those 13 bear market studies that I did going back to 1970.
Okay. All right. Well, so and do you have a few stocks that the guys want to bring up? Connor and
Well, the 21
Michael?
the 21 over 21 will be check that tonight, but I know Connor has some from his sectors that he focuses on.
Connor, what do you got?
Yeah, so I have 5 new ones different from last week. So Don, if you could pull up the chart of TCOM. So yeah, this is quite the theme this week has been, a lot of China names have been moving higher. The China reopening has really been driving a lot of these names, but this caught my attention on my sector list, and it's trading well above the medium, long, and short term moving averages. So it looks really healthy in that aspect. And with all this China stuff going on, it can cause a lot of volatility, swings in both directions. So you have to be careful in that aspect. But consumer spending is supposed to see a snapback rally in China, and it's supposed to grow 11% this year. So Trip.com could see some benefit from that, given they're involved in the accommodation of hotel and airline ticketing. It's a little extended, but it's been really strong. Another one is WYNN.
Win.
Let's go to Macau.
Yeah.
Yeah, I'll just be
Buy it.
I'll just be brief with this one. I mean, it's over the long, medium, and short term moving averages, and like I just previously said, that this China reopening is really driving some of these stocks positively. Next one, NKE. So yeah, it had this really strong earnings gap up, and I think anytime a stock can gap up on earnings in this current environment, it's very positive. And when you look at the chart, it's just been riding that ADMA, and a couple stocks this year, when they gap up, come back to the EMA and just ride them, it's a big positive. So if it can continue to hold this short-term moving average, I think it definitely can hold this trend. And it's definitely a character change, with many of the other retail apparel stocks also showing similar looks. Next one is DOX. So this one gapped up this week and then came down to retest that pivot gap up point, which coincided with the AEMA. And this is a prime example of how it's been tough to buy breakouts this year. But the more smart thing to do is, if stock breaks out, wait for it to come down, retest that pivot point, AEMA, and see if it can move higher from there. This is in the computer tech services. So basically what they do is they just provide business support system softwares to service providers involved in the communication, media, and entertainment sector. Trading well above the 200-day, so that's just always a positive in this environment, especially with many names trading below it. And then my last one is LW. This is not, the hottest sector stock, but it's in the food packaging sector, and it's a staple. And I think something we cannot ignore is that these staples continue to make new highs and crush earnings. Like, as you can see, yesterday it had a killer earnings, 4.8 billion in sales, along with 600 million in income, and they updated their 2023 fiscal outlook. And yeah, it gapped up, and now as you look today, it's strong again today. So although it's in the staples, something to keep an eye on.
Yeah, those are growth. Yeah, those are growth fundamental numbers in a staple sector. That checks all the boxes.
Right.
So now the question is that too extended to try to add a position, or do you got to wait till it pulls back to the 21, or how do you play that?
Yeah, for me, I think it's too extended. Let those moving averages catch up, and maybe a lot of times I notice is when these stocks gap up on earnings, they'll come down and retest the bottom of the breakaway gap, I'll call it, and sometimes they can just explode off that. So yeah, in the short term, it definitely is a little bit extended.
Folks, listen, I want to bring up one thing real quick. So Don, we have a YouTube channel. It's called Revere Asset. Just Google Revere Asset. Just Revere Asset. You can pull up, and if you hit subscribe or follow on our YouTube channel, when we put out this podcast, it'll go out literally like in a couple hours versus getting it in the newsletter mail normally on Saturday morning. So you get it literally probably even before the market closes if you want. Now, but Don did a gap up video. He did about an hour, maybe not an hour, maybe 45-minute video on gap rules, just gaps, because gap stocks are very difficult to play because more than half of them are going to gap and crap, and they'll gap and then they'll just turn around and roll right over. But the couple that do stay up there and then continue just to explode higher, right? How do you participate in those but not get creamed by the ones that gap and crap, right? That's exactly what Don did. So whenever you buy a gap stock, you got to have rules and you got to be willing to sell if the gap doesn't hold. Anyway, for those people that are interested in that, just go to YouTube. And it was a couple of years ago. You could just go back and find it, but it's called Gap Rules. We made it real simple for you. Anyway, sorry. Go ahead. Was that all?
Yeah, that's it.
Okay. All right, Michael. Do you have any stocks?
I can just go through a couple quickly. Disclaimer: I do own these names. One of them is AbbVie, ABBV, which is breaking out of a cup and handle today. Like that one. It's a pharmaceutical company, one of the big ones. Then another one is PICK, the miners, ex gold and silver, own that one as well, and the miners are having a good day today as well. Breaking out, I think the miners could be a theme going forward for the next 5 years, even just in terms of electrification and the need for base metals and materials. Another one is XHB, the home builders. I've been in that one for a little bit. Home builders, I mean, there's a lot of negativity around them, but the charts don't lie, and those are doing pretty well as well. And then last one that I'm looking at, I don't own this one, is Mondelez, MDLZ, And going on to those snacks and food packaging companies, this one looks like it's ready to potentially break out as well. So um, that's what I'm focusing on.
Yeah, and folks, listen, one thing I'd like to point out. So he was talking about the electrification and the demand. We're seeing huge increases in demand for these metals, nickel, cobalt, lithium, all that kind of stuff. So you don't actually have to play the metals themselves. You can actually buy the infrastructure or the equipment to mine the metals. It's like the old adage during the gold rush in the 1800s in California. You don't want to be mining the gold. You want to be selling the shovels, right? Because only, 1 out of 100 guys are going to get rich during the gold rush panning for gold, but the guy that sells the shovels and the pans gets rich. So in any event, you got to look at other ways. There's different ways to play the mining and the metals. I'm not saying you don't own the metals or you don't own the miners. I'm saying there's also auxiliary sectors around those that can also be very beneficial. All right, folks. Well, listen, Don, you got anything else before we close?
No, I think that's a wrap. We've covered pretty much everything in what those key levels are.
All right, folks, listen, if you like what you heard, please tell a friend, tell a neighbor, just tell them to go to revereasset.com. Up in the upper right-hand corner, there's a subscribe button. They can just hit subscribe, and they can put in their name and their email address. We won't spam them and send them a bunch of junk mail. We didn't even do anything with that list except put them on the newsletter list. And every day the market is open, the guys do a short daily, it's called Daily Market Insights video, setting up for the next day for the morning. And then this podcast goes out on Saturday morning, and they'll get all of that without having to do anything. It just goes right to their inbox. There's also a contact button to the left of that where you can actually send, it goes directly to me. You can send me a message saying, what do you think about this stock? Or hey, I'd like to, you can even schedule a meeting, but you can get a complimentary portfolio review. Or if you just have a topic that you want to talk about on the show. Remember, we are free of conflicts of interest. We are not a broker. We're a fiduciary. We only represent the client, the buy side. We are not affiliated with any custodians, broker dealers, insurance company. We don't work on commission. We don't do any of that stuff. We put out more financial and market information complimentary and show you what we do. We're not the Wizard of Oz. We pull back the curtain and show you exactly what we're doing. And clients have even told me when they become a client, that newsletter really comes alive because now they see in real time in their account what we're actually talking about on the newsletter. Anyway, you can reach out to any of us if you want. Dan at revereasset.com, Don at revereasset.com, or Michael, Ted, or Connor at revereasset.com.
Got them all.
I got them all right. I almost said one of the old guys. And Zach's over here going, you finally got it. Only on the 10th take. That it's January. You finally got it this year. You got it right. Well, hopefully my New Year's resolution is to get everybody's names right and not call anybody the wrong name by habit.
Starting off great.
In any event, we got all the emails, and you can always call us old school at 855-REAL-WEALTH. Folks, I hope this is a wonderful and prosperous 2023, and we're gonna work hard at Revere, and we'll give you all the information that you need for an investment portfolio. We'll talk to you next week on Your Money.
Because it's not how much you make in the markets, it's how much you can keep.